All right, let's dive into Mistras Group, ticker MBG. Now, their latest earnings report just dropped, and at first glance, it looks like a miss, but the stock popped over 10%. So what's really going on here? That's what we're going to figure out. So this is the big question, right? You've got an earnings miss, but the stock rips higher. That's a huge disconnect. It tells you pretty clearly that Wall Street is looking past the headlines and seeing something deeper. And that's exactly what we're going to unpack today. Okay, so let's look at the raw numbers. Non-GAAP EPS missed by a nickel. Revenue came in just a hair light. If this was the only slide you saw, you think, okay, bad quarter and move on. But that would be a huge mistake. The real story, the one that drove that stock pop, was happening way below the surface. And that's where we're going next, beneath the hood, into the profitability story. Because this right here is why the market got so excited. It's not about how much money they made, but how they made it. Investors blew right past that tiny revenue miss and zoomed in on the quality of the earnings. And what they found was pretty impressive. First key metric, gross margins expanded by 200 basis points. That's a full 2 percentage points year over year. Now, that doesn't just happen by accident. This is the result of management getting really disciplined. They're cutting out low-margin work, focusing on a better mix of business, and just running a tighter ship. This is the first big green flag that the new strategy is actually paying off. And when your margins go up, what happens next? Well, this happens. A record Q2 adjusted EBITDA. We're talking $24.1 million, which is up almost 9% from the same time last year. This is where the rubber meets the road, folks. Those operational improvements aren't just theory. They are flowing directly to the bottom line. And that's what investors love to see. Okay, so better margins, record EBITDA, what else? How about the growth engine? Their data solutions division, specifically their PCMS software, grew a whopping 30% year over year. And let me tell you, not all revenue is created equal. This is the good stuff. It's high margin, it's sticky, meaning customers don't leave, and it's recurring. This is a huge piece of the puzzle, so let's zoom in on it. All right, let's talk about this growth engine, PCMS. Honestly, this is the company's secret sauce. This is what could transform Mistras from, just another industrial services company into something much, much more interesting and a lot more valuable. So what makes PCMS such a big deal? Well, a few things. First, it's a software business, which means fantastic margins and recurring revenue. They're already embedded in half of all U.S. oil refineries. That's huge. Second, it creates this incredible ecosystem. Once a customer is on the PCMS platform, it's way easier to sell them traditional inspection services. It's a classic cross-sell. And it sounds like customers are loving it. Management was just talking about their recent user conference, and the buzz around the new mobile version was off the charts. So you see how the pieces are starting to fit together? The margin expansion, the record profits, that exploding software business. None of this is happening by chance. It's all part of a very specific, very deliberate new playbook that management is running. Let's break down exactly what that playbook looks like. Okay, so the strategy is simple, and it's all built around one idea. Profitability is king. They're calling it their North Star. So, step 1, prune the business. They're closing labs that don't make money and getting out of businesses that are a drag. Step 2, get lean. They're cutting costs and flattening the organization. Step 3, focus on what works. They're doubling down on high-margin areas like aerospace and, get this, data centers. And finally, step 4, take all that extra cash and pay down debt. It's just a smart, disciplined, back-to-basics plan that's clearly focused on creating value. The CEO, Natalia Schumann, put it perfectly on the call. She said, we're really shifting from transactional relationships to strategic partnerships. And that quote says it all, doesn't it? They don't want to be just another company you call for a one-off job. They want to be embedded with their customers, becoming a critical partner that helps solve their most complex problems. That's a much stickier and much more profitable place to be. Okay, so we've seen the numbers, we've unpacked the strategy, now for the big question. What does this all mean going forward? Let's get into our take here at Talk Tickers. Where is this company headed, and what should we be looking for next? All right, here's our forward look. First, on revenue, we're actually calling for it to be flat to maybe slightly up. Now you might think, wait, why not higher? Well, it's because they're still cutting that low-quality business, which will cancel out some of the growth from their strong oil and gas segment and PCMS. But, and this is the key, we think adjusted EBITDA is going to keep climbing and beat last year's number. Why? Because those margin improvements and cost controls are real and they're sticking. As for the stock price, we think it probably chops around a bit in the short term as the market fully digests this new story. But after that, the trend should be up as these better results keep rolling in. So let's put a bow on it. You've got a clear turnaround story playing out. You have disciplined management pulling all the right levers on costs and profitability, and you have that high-growth, high-margin software business that's really starting to hit its stride. For us, that all adds up to one thing. Our official rating on Mistras Group is outperform. Okay, to wrap things up, let's have a little fun with a trade idea. Now remember, this isn't advice, but this is the kind of pitch you might hear tossed around on a trading desk or at a hedge fund. So here's the pitch. It's a pairs trade. You go long Mistras Group, while at the same time you short a basket of its old-school industrial peers. You could use an ETF like XLI to do that. And the whole idea, the thesis, is really simple. We believe the market is waking up to the fact that Mistras isn't your grandfather's industrial services company anymore. It's becoming a tech-first, data-driven company. And as that transformation becomes more obvious, we think the stock is going to get a major re-rating from Wall Street, closing the gap with its peers and then some. And we always have to say it, this analysis is for informational purposes only. This is not financial advice.